Let me take you back in the history. It was the morning of September 29, 2008, and I promise you I'm gonna make this video as interesting and as juicy as possible because what we are seeing today, wow, this is no less than 2008. Okay, so let me take you back in the history. It was the morning of September 29, 2008. The US has already seen the fall of Bear & Stearns and Lehman Brothers. Stock market somehow managed and took those punches well, with slight losses of course. Then on Thursday, September 18th, 2008, market rebounded by more than 400 points as investors learned about this new bank bailout package. Then on Friday, September 19th, 2008, Dow ended the week at 11,388. It was only slightly below its Monday open, which was about 11,416. Then on Saturday, September 20th, 2008, Federal Reserve Chair Ben Bernanke sent the bank bailout package to the Congress. The Dow bounced about 11,000 until September 29th, 2008. When the Senate voted against the bailout bill, that was it. The Dow lost 777 points during intraday trading. Global markets panicked all over the place. Congress finally passed the bailout bill in early October, but the damage had already been done. The Labor Department reported that the economy has lost about 159,000 jobs in a prior month. So just in 1 month, we lost about 159,000 jobs. And the rest is history. It took us 5 years to come back to the 2000 level in the stock market. Now, if you can just look at S&P 500 chart from September 28th, 2008 to the all-time low in October, you can see that we lost almost 45%. But we were losing steam way before that. Now, that is all well and good, and it was a very exciting history lesson and a good, I would say, thing to remember. But what does it mean for our stock market right now? Well, let's take a look at some data which is suggesting the coming recession with the timeline. So I'm going to share my screen and I will try to make this video as intuitive and data-packed as possible. Okay, so this is S&P 500 right here. And look at the date. This was September 29th, 2008. It was a Monday. Right here, September 29th or 29th, yeah, 2008, actually, right here. Okay, so since that, if we come all the way down to March of 2009, so I'm talking about September, October, November, December, January, February, March, the stock market continued to go down. It has few up days, but then it never came back into the full form as it was before the crash. March of 2009, it bottomed at about 500, or it lost almost 532 points all the way from September, or 44.37%. So it lost all the way from September 29, 2008 to March 2009, about 45%. Okay, so this, what you see here, is really damn scary when you look at how much percent we lost, 44% right here, 44.37%. Now let's talk about what are we going to see or what are we seeing in the market right now. I mean, if I quickly share this with you, I mean, this is scary. Let me take you to Tesla, for example. Tesla went down all the way to 794. When I'm recording this video, it kind of gained and it's at about 802. But I'm sure it's going to have another down day or another down streak, as we can say. Okay, so I'm going to come back to this right here. So now I'm going to present, or I'm going to show you the data, actually this right here. This is a better format. Okay, now I'm going to show you the data that talks about what banks are talking about. These are the credit cards. Credit card is a great indication of where the people are heading, how they're spending, and what to look forward to in the coming days. So over here it says past due rate rising, yet still down on year-over-year basis. So the past due rates on different credit card, American Express, Discover, Bank of America, JP Morgan, if you notice over here, you can see that the past due is inching up, as you can see right here. Past due is inching up when what it was in Q2 of 2021 as compared to what it is right now. It's drastically higher, but it's not as high as it was pre-pandemic level. So pre-pandemic level, we're still doing good. People still have money to pay down their debt, but it's coming up and it's climbing up. That's one indication. And we are going to mark first indication here, okay? Now let's take a look at the second indication here. Okay, this is second indication. where we are talking about net charge-off reflects still low delinquencies. So the delinquencies are still low as compared to pandemic level and also at pre-pandemic level. I mean, people, and that's why they are saying the economy is really strong. People are still spending money because they are looking at these factors and they're like, well, people are not running behind or delayed in their payments. Delinquencies are still low, but they are going up and they are in the wrong direction right here. So if you can see all the same credit cards over here, and you can see we were the lowest in third quarter of 2021, and since then we have started to see an uptick. Some cards more than the other, but we have started to see an uptick in the consumer I would say delinquencies, but still they are not as high as they were. They were almost 5% back in 2020 second quarter, but 2020 was pandemic. They were almost close to 6 over here in 2019. So since that they have come down, but now they are inching up and they're going in a different direction. That's number two. Number three right here. Okay, number three, debt service ratio is still below pre-pandemic level. So this is a debt service ratio, and you can see that we are at 9.34 as compared to in 09, 010, 011, and all the way to 019, we were maintained at that 10 level. So we are still down from the pre-pandemic level, but we were as far down in 2020 when we had that all that free money available. People were making money in the stock market. We were kind of, in this debt to service ratio was actually pretty low, but then now started to inch up. That's number three. Number four, and I promise it's all going to make sense. US unemployment rate back to low after COVID-19 spike. So we had that huge spike in COVID-19 when the unemployment rate went up super high. It has come down, and that's what the Fed is looking at, that hey, the job market is really healthy and really strong. But there are other things cooking in the stock market. Okay, now look at number five with few important points. GDP, unemployment, CPI, core CPI, and Fed fund rate. This is where it all comes together and makes sense. Look at the GDP percent over percent. So the first quarter of 2022, 1.2, second quarter 3.5, and in the third quarter it's slowing down right here, and you can see in 2023 we have 2.2, in 2024 we have 2.0. When GDP slows down, inflation goes up, that's a problem right there. Then unemployment rate 3.5. Yes, 3.5. They are maintaining it at 3.5. So they are pretty confident that they can maintain 3.5 all the way to 2024. But look what's going on with CPI. CPI is going to start triggering down and coming down as compared to what we had in the last year. So which is of course good. That means the prices of the commodities are coming down. But there is one more thing that's happening here. Look, the CPI 7.8 and the core CPI 5.3 as the second quarter of 2022. But look, the main CPI 7.4 and the core CPI is actually going up in third quarter of 2022. So right now it's going to come down to 5.3 in the second quarter of 2022, but they're estimating that in the third quarter, the core CPI will go up, and then it'll start to trend down, and we are going to settle at about 3.0 in 2024. But look what's going on with GDP. GDP is slowing down, coming to like 2.0, which is not good at all. This is what the scary part is. And Fed funds rate 1.2% in second quarter of 2022, going up as much as 2.25%, and then reaching up to 3% in 2024, in 2023 going as high as 3.25%. So this is what Bloomberg is basically now saying. There is a 0% chance, and this is all the summary right here. There is a 0% chance of US recession in 2022. There is a 44% chance in 2024. That's Bloomberg economist model is suggesting. So this is over here 2023, and recession probability rises sharply in late 2023. And in late 2023, we have the GDP that basically slows down. And when the GDP slows down, the unemployment rate remained the same, and the GDP was high, there's a huge problem right there. So that's what they're saying, that by January of 2024, there is a 44% of chances that US will be in recession. Not right now, there is a 0% chance of recession. Let's read this together. There is an increasing chatter about the risk of recession in the US, with the recent yield curve inversion and commentary about prominent economists catching market attention. Using a comprehensive set of economic and financial market indicators, Bloomberg economics have estimated a recession probability model. The model suggests the change or chance of recession within 12 months is close to zero. That is similar to the probability suggested by the Fed Chair Powell's preferred measure 1% chance, but lower than the odds suggested the models that rely only the 2-year 10-year yield curve spread 29% or 3-month 10-year yield curve spread 17%. So this is what's going on. people or Bloomberg economists are basically saying that there is no chance of recession in 2022, but there is a 44% chance in 2024. Now, that is all well and good, but stocks are feeling the effect of supply chain issues, of Fed tightening, of interest rate hike now. And just imagine what's going to happen in 2024 when there is a higher chance of recession by 2024. So I think market is playing. I'm going to show you the chart again. So this is the chart right now. And when I'm recording this video, it's about 3:22 p.m. And just before I showed you Tesla was at 803. Look at Tesla now. Tesla touched almost right here. Tesla is touching almost 794 of our all-day low today. And then right now it's trading at 796. So stock market is in a total panic. And this is going to continue until we get some direction from the market, and that direction is going to hard to come by. And stocks like Apple, stocks like Tesla, stocks like Google, they are going to suffer. Look, Apple is down 3%, Tesla is down 8%. I mean, these are big numbers for these companies. Apple rarely goes down 3-4% like that. That means the total panic is taking over the market. And I'm going to now share a story with you, and actually I'm going to share a picture with you with that story. Give me a second here. Okay, so my investing life started in 2008. I was totally unaware of the market situation, and I was not even in the market. So I was not, paying attention to the stock market or what the Fed is doing or what the crisis is doing. And then one of my friends suggested buying Apple because they came out with the iPhone and it was doing really well. That's when I started to learn about stock and the world of investing. So pay attention to this right here. I'm only going to share actually this over here. Yep, you can see. Okay, so take a look. I'm gonna enlarge this here. This is my first buy of my life, the Apple stock that I bought on October 10th of 2008. That's when I bought Apple, and I basically bought 112 shares and I paid $3.34. That was now pre-split. At that time, I think I paid about $20 or something, like $17 or something like that. But then it split many times after that. So I basically bought 112 shares at $3.34, and then I bought 2 days later, 10/13/2008, I bought 140 more shares at about 3.75. I have about 6,000 shares in this account today, and I kept buying. Of course, this was my first buy, and I kept buying after that. So the reason why I'm trying to share this with you guys is this, that unknowingly, and I'm going to share this chart right here. Look, unknowingly, I bought Apple at the lowest low around right here. So this is S&P 500, right? This was September 29th, and I bought around October 10th. So it was right here, somewhere in between that. And then after that, I bought a few more shares. But look, the market went down after that even more. So this was not the rock bottom that I caught. I didn't catch the rock bottom. Rock bottom would have been over here in March of 2009. But what I did was I started to invest and DCA slowly at these levels over here unknowingly. Of course, I wasn't aware of the market or what the market was doing. So for me, buying a stock was like, okay, I'm just buying the stock because Apple is doing good. It's a good company, and I want to invest in Apple. But knowingly, unknowingly, I continued to buy more and more Apple as the market opened up, as the money started to flow. For 5 years, it took 5 years for us to get back to the 2007 level. But I didn't know the 2007 level, right? Because I was investing in 2008. So for me, I started to do good just 3 months after I was buying it, because after I'd say March of 2009, the stock market started to see a rebound. We didn't see the market come back to the 2000 level for 5 years, but those who bought like myself, right at the bottom, we saw the change within like 4 or 5 months. I saw the price of the equity was going up. So I was really excited about it. I was like, this is damn good, because I put like $5,000 and now it's $6,000. And at that time, I was just starting my life. For me to make $1,000 without doing anything was a very exciting thing. So the reason why I'm sharing is this, that we all have our way of investing. And if we invest in times like this, like stock market today, I actually bought more Tesla today in my 401k account, which I basically tell the broker to go ahead and buy it for me. So I didn't put any alert to the Discord members because that's not the account that I manage, but I bought more Tesla today at 800. My price was 800. So what I'm saying is that when you buy on days like today, when you buy in market time like today, and if you are entering a brand new stock or a brand new equity, you will see the return within few months. And for us, like, yeah, of course, some of us, we bought Neos and Palantir and SoFi at all-time highs or basically at high values. So for those stock prices to come back to that level, it's going to take time. But if we are buying it today, a brand new stock, for example, I've been eyeing Disney for a long time. I want to get into Disney. I want to buy Disney. I haven't bought Disney. So if I buy Disney today or in the next few weeks, I will see the return in Disney a lot faster and a lot quicker. So again, what I feel like is that this market is giving us a chance to basically do what we always wanted to do, is to DCA and get more and more of the stock that we like into our portfolios. So that way, it's when this is all said and done, we are not sitting back and regretting it. I mean, just think about it. If I would have just bought these stocks at the all-time high of 2006 and 2007 market, I think I would have never invested in stock market, because I'm going to tell you my reasoning. The reason why I got into it and I got more bullish about the stock market is because I entered at the right time. Unknowingly, I just entered at the right time. And nobody was there. My friend just told me about Apple and the iPhone, and that's when I bought it. These days, we have so much resources. I mean, YouTube is a phenomenal place to kind of do your research and to know about the companies. So I wanted to share this, that these are the times when you have to be very, very aggressive and very, very bullish within yourself. Forget about what the market is telling you, what the news is telling you. If you believe in the company, I believe in Tesla more than any other company in the market right now. Tesla, Apple, Google, these are the companies that I think are going to be profitable much faster than the SoFi and other companies, because SoFi is still a baby company. They still have a lot to prove, but these companies have been proven many, many times before. So these companies will come back faster, quicker. Of course, they may not be the leaders, because I was just listening to the article or the news, they were talking about how the leaders of yesterday is not going to be the leaders for tomorrow. I doubt it. I think Tesla is going to rule regardless. Apple is one of the safest company to invest, in my opinion. Again, my opinion, not a financial advice. I'm also planning to buy my first ever property or real estate investment of my life. I mean, so far, what I have bought is for myself. I mean, where I plan on living is what I bought. And I'm getting ready to invest in first ever investment property. I've never liked properties because I don't do well with broken pipes and leaky toilets, just not my thing, because I feel like, the time is well spent other places. So that's why I never looked into owning a real estate. Of course, I bought a condo back in 2007. Timing is everything. I bought a condo in 2007, paid really top dollars for it. And then after that, when I bought a different house, I rented that out and it was full of problems. All I got was bad tenants, won't pay rent, broken toilets, and I have got a call at like 1 a.m. I didn't enjoy any part of that. But I'm going to start that journey very soon back again. And I want to make all of you guys a part of it, because I feel I could learn a lot from all of you guys watching it. So if you want me to share a step-by-step process of me getting started in real estate market in the coming months, as I feel we are going to see a massive crash in the real estate market in the next 6 to 8 months, almost 15 to 20% drop. And I feel that'll be the time for me to start in real estate, because now I found a person who will manage everything and I don't have to do anything. I was waiting for that one link to kind of link up so I can say, okay, this is the money, please go ahead and of course I'm gonna buy, I'm gonna look at the deal, I'm gonna make sure everything is all the T's and all the dots are properly crossed, and then I will go ahead and make the purchase. So let me know in the comments, and I will actually start a series of videos where I will walk through the journey together, from selecting a property to buying, etc. All of it done with you guys in it, because I feel that's the best way I can keep myself motivated to go ahead and do it. And also, it's a great experience for both of us. And since I'm a newbie in that area, that could be a perfect learning tutorial as well for me. So definitely let me know in the comments, and I'm sure some of you are pros at it, would love to learn from everyone who's watching this video. Or if you want to get started into it and you're like me, like you never thought what could be the right step or the right way, then I think, friends, we have a journey together. Hope you liked today's video. Let me know in the comments your opinion in the coming recession. And also, I'm going to link my timing the stock market video over here, so definitely check it out. As always, a pleasure to share this. Until next time, you all have a sparkling day.